just like to thank everyone for taking the time to come today. It's Saturday morning, it's a sunny morning. I know there's lots of other fun things you could be doing, but I do appreciate it. I just go right into it talk about 2022. I'm sort of tired of talking about 2022, but pretty much if we could have gone against us in that year, it did go against us. We had interest rates going up, we had oil prices going up, we had the war in the Ukraine, we had the change in regime. But that's all behind us now. And what I'm going to talk about in 2023, about bridging the gap, and we made it through 2022. It wasn't a fun year. I like to say we were the cleanest dirty shirt, but we didn't fall apart. So on to 2023. So when I get started, I'm going to talk here about what we're going to cover today. All right, so here's my agenda. So let's start with the tough stuff here. What is going on in the economy? So let's talk about the strengths. So governments are actually running some unexpected surpluses. So take Newfoundland, for example. In 2022, they were projecting a deficit of $351 million, and instead they had a surplus of $471 million. Now that's a difference of $830 million. If you talk about the basic economic position, Canada's is actually quite strong because we have what's in demand, which is specifically energy and materials. The U.S. has got a ton of job openings, and U.S. consumer mortgage debt is actually quite low and has been steadily decreasing since 2008. So what's causing all this worry? Well, sentiment is negative. So I could put up a slide telling you how pessimistic people are, but there's really, what's important to know is that negative sentiment does not equate to negative stock market returns. It can actually be a contrarian indicator. There's a big fear of 1970s style of inflation, and I hope to reassure you that we don't have the same flu that we did have in the 70s. And again, this fear of recession. So this is more complicated, and as my friends in this cartoon say, the stock market is not the economy. So moving on, let's talk about some of the big offenders today. Interest rates and inflation. Now, interest rates and inflation have been a hot topic in 2022, and I believe that you can't talk about one without talking about the other. And last year we had various sources of inflation. We had the reinflation as we emerged from COVID. We had the change in demand from goods to services. We had supply chain issues, and then we had the war in the Ukraine, which led to the increase in the price of energy, and then all the subsequent related items such as the food, transportation, and then eventually labor. So this is great, the housing market. If we take a look at it, you can see that inflation leads to higher borrowing costs, which can in turn lead to affects affordability and ultimately pricing. So Alberta didn't have the big real estate boom that everybody else had, but that Toronto and Vancouver had, but you can now see that we're showing signs of strength compared to their slowdowns. So all those smart people from Toronto and Vancouver should be selling all of their property and moving here. And for all of you who have vacation property in BC, you can still keep it. All right, so when you talk about inflation, you need to talk about two items, which are growth and rate of change. On this slide, I am going to use oil as a proxy for inflation. So here's basically the spot prices of WTI from 2022. What this is the rate of change in dollars, right? It's volatile. I don't have to tell any of you this. But what's important is the rate of change in percentage. And why I put this up is that's what the indicator of inflation is. So even though we still have high prices, these are still pretty high, the rate of change is coming down. Right? That's how you can see inflation slowing. We're not going to wait for oil to go back to $20 until somebody says inflation's over. It's all about this rate of change. Okay? So one of the Fed's tools that they use to slow down inflation is to raise interest rates. I talked about this before, but you can see on this graph that we've had eight increases in 2022. That is a lot. And you could say, actually, if you wanted to be sensationalize it, you could say that's an 800% increase in the rate of interest, which is also true. But what you want to look at here is we've overlaid this graph, and it's the same answer, which is the rate of change slows down. So in the beginning, when you're raising these rates, the effect on your borrowing costs is significant, right? It's basically almost a double. And even though the rates are higher, the pace, the rate of change is slower. So the incremental cost becomes slower at higher price levels. So how did bonds behave last year and what's going to happen next? So bonds as a group. So last year they were about -20. So when you have bonds in your portfolio, they're supposed to be stable. We've been taught that they go up when the markets go down. That's not what happened. So I wanted to give you an example here of an actual bond so I can talk about even though they are showed negative for 2022, let's talk about the behavior of bonds. So this is an example. In this example, this is a real bond. Some of you own it. It's a Bank of Nova Scotia note. It matures here in 2028 and $100,000 was invested. With a bond, you can see daily pricing. So if you choose to sell it at any time, you can get a price for it. For a normal bond. So you can see the bond price went from $99 to $105 to $113 to $106 to $96. This is actually the real numbers of how your bond behaved. So if you looked at an investment went from $113 to $96, you might think, oh, I just lost all this money, but you didn't. It was always going to come due at $100,000. Sometimes it's opportune to sell them in the middle of the period of time, but in this case, so when you're looking at your bonds and you think they're down, unless we have problems with creditor risk, they're going to be fine. And in our portfolio, we don't have any problems for bonds we've bought with creditor risk. But I would like to now talk about the bond portfolios. So the one portfolio that we own is called the PIMCO fund, and it's also had poor performance, like all bonds have this year. But when I take a look at it, they don't have any creditor risk. It's priced as if defaults in their underlying portfolio are going to be at 11%, but in 2008, the actual defaults on those types of bonds were only 2.3, so way overly pessimistic, and it's paying a 9% distribution yield, which is only 85% of the interest payments they collect. So I'm expecting to see some good returns here. And GICs, earlier this year you could get them for a very short period of time at some pretty decent rates. The difference between a GIC and a bond is that they don't show you all these interim stops. They just show you where you started and where you end. So that's the difference. So yes, you can get your 4% right now on your GIC, and for some people you might want that. It's here. At least they're actually paying some numbers. They weren't paying the 1% that we were looking at 2 years ago. So the next thing I want to talk about is the S&P 500, the stock market returns. So yes, bonds were frustrating last year, but I think they'll correct themselves. And now let's look at the equity markets. So before we talk about what's going to happen, let's take a look at what did happen. So here's a chart we all want to talk about. There was one bright light last year, and I know I pretty much feel like cheering about it. But here it is. So oil and gas. So what I'm going to talk about is how long is this going to last, how high is it going to go, and how much should we own. So how did we actually outperformed that dismal graph, and here's how we did it. We had more winners than losers compared to what was in the S&P 500. So even though of all the stocks we owned in 2022, only 47% of them went up, in the S&P 500, only 31% went up. And I'm going to say that that's going to be a continuous theme for the next little while. We have to be fussy about picking our stocks. It's not going to be good enough to just say, just buy everything. The other thing I like to talk about, which was odd in 2022, is that revenue expectations and earnings results, 70% of the companies and 71% in the companies in the S&P 500 beat their estimates. So you have 70% of the companies saying, I'm going to make 100 million. They made 102 million, and 70% of their companies had their stock prices go down. So that's a bit of a disconnect. That speaks to the pessimism I've been talking about. But again, I think that leaves some opportunities for 2023. Inflation. So now that we're in a higher interest rate environment, the new question is this hurdle rate now too high for a business? And this is how a lot of us feel that the Fed is doing when they're targeting inflation, is they're kind of guessing. And because if that's a lot of the perception of corporations and the general public, people are going to err on the side of caution. Now what this chart shows is a really fun chart. It shows the comparison between the nominal yield and the real yield. Now what that is, the nominal yield is the rate of return before inflation. The real yield is when you subtract the two. So if I'm going to pay you 4% on your GIC and inflation is 4%, your real yield is 0. Okay? So what you're looking at here is even though rates have gone up, the real cost of borrowing is still really low, right? Look at how high costs of borrowing were back here. So what I want to talk about this is even though rates aren't as cheap as 2008, they are cheaper than the 30 previous years. So in the 30 previous years, in that 30-year period, the S&P 500 was able to average a compound growth rate of 7.5%. So as a long-term investor, here's your chance to guess. So if you had invested $1 at that 7.5, take a guess, what would it be worth 30 years later? 250? 250? Okay. $10. But guess what it would be worth today if you go back to the beginning of this chart from 2008? The answer is $40. $40. So I guess what my point is when you're investing, that's where you get this compounding over this long period of time. Is just actually participating for a long period of time takes your growth and it does this. It grows. So I thought that was pretty nice to know. So let's talk about the Fed funds target rate. This is a previous question that was asked of me. I don't know if we're on page 35 or not, but here's the answer. So basically this is an arbitrary number, right? When they're saying what do we want to target. And right now they're targeting 4. So if they increase what their target is from 2% to 4%, recognizing where inflation is, that takes some pressure off of them from having to decrease rates. Increase interest rates to decrease the Fed fund rate. So they've increased their target. Will it go higher than 4? I don't know. I think that, remember, the job of the Fed is to create price stability, and price stability is constant, consistent rates of inflation, not growing rates of inflation, but also consistent equity asset values, and that's the stock market. So they have to be careful. That is part of their mandate. Okay, now I like to show this slide because it identifies different crises that we've had that have led to lower rates. And you can see there have been a lot of them over the last 60 years, but if you look at this graph, the tightening periods, well, you can't see the pink very well in this PowerPoint, but you could probably see it on your presentation, that the tightening periods have been generally shorter than those nice blue periods. So what's this mean going forward? Well, basically, it's not a perfect science. There's a lot of guesswork, and this is for the Fed, there's guesswork, there's time lags, but I expect that the worst is behind us because based on the fact that the pace of inflation has slowed, the Fed has increased the target rate of inflation, so there's a good argument to say, let's have a little bit of a wait and see for the current changes to work their way through the system. Now, on that note, this was a great question I had asked of me. So I want to look at the behavior of the stock market through periods of time when inflation outpaced GDP growth, because that's what I hear. We're going to have high inflation, but we don't have GDP growth, so therefore this must be bad for the stock market. And I picked the 1980s because the fear of inflation right now really is the fear of the 70s. So that's why I picked the 1980s as a period of time to look at. And when you come back to the 80s, many of you can fondly remember, half of you fondly remember high interest rates on your GICs. The other half of you cringe when you remember the high interest rates on your mortgages, right? So it depends on really where you were. So what are we looking at here? Well, the blue line is inflation, the orange is GDP growth, and the green is the S&P 500 return. So my comment is, I don't think there actually is a relationship. So take a look at 1980. That's the one on the far left. Inflation outpaced growth, and the market was pretty strong. Well, look at 81. Inflation and growth were pretty similar to 1980, and look at what the stock market did. Right? So that was no good. Then go over to 1982. Same problem. Coming out of the bad market, inflation outpaced growth, and the market did well. In 83, growth outpaced inflation. You can see that we're going to have growth, we're going to have a growth number, we're going to have an inflation number, we're going to have a stock market return. When inflation outpaces growth, that has more, I think that where the effect is on government budgets. That's where you see it. How much money do I have to spend on my Medicare because all my bills went up? How much do I have to pay for my healthcare workers? But it doesn't necessarily relate to the stock market, based on what I can see. And here's our last chart on valuation. Okay, so what it does is it shows the forward PE ratios of the S&P 500, which is a commonly used metric to talk about, is it too expensive or is it too cheap? And right now it's sitting here at about 17.2, which I would say isn't really great, isn't really terrible. The fear is that it'll become a bigger number if earnings are all missing, but it can get complicated. You can always argue why it will go higher and why it will go lower. What I think is more interesting in this slide is that these are bumpy rides. So in the last 14 years, when this is since 2008, in 14 years, there have been 18 sell-offs. So if you're invested, you need to expect that the chances are at least once per calendar year, we are going to have a sell-off. And if another way of looking at it is that I added this up, over 5,110 days, 1,675 are negative. So basically 1 out of every 3 trading days is going to be negative in your account. And I think you just have to sort of, you can't be afraid of that. You just have to sort of say, well, I guess that's what's going to happen. And it's not Monday's up, Tuesday's up, Wednesday's negative, Thursday's up, Friday's up, Monday's, it's not like that, right? It's up for a period of time, down for a period of time, but over a long period of time, that's sort of what those numbers come out as. Any questions about that? Well, I'm hoping that since we had so many negative days in 2022, we're going to have more positive days in 2023. That was my plan. Okay, so are you ready? Here we are. It's been a long time coming. And here our winner is, it is oil and gas. And if you've been coming to these presentations for a while, you know that I'm not usually saying that. So, as we previously saw, oil and gas was the best performing sector, and at the end of 22, it was the only sector that achieves positive returns for the year, and this has got the attention of investors. So let's just recap what's been happening in the industry. Oil and gas has been tremendously unpopular, okay? It's been heralded as the destroyer of the planet, and it's been pitted against the renewable options, and this argument has caused change in behaviors, okay? So there is a preference to avoid investing or to limit investment in fossil fuels. There's a preference to avoid investing in companies that are energy companies, and there's a preference to take profits from energy companies and redirect them to more, suitable items. Now, let's take a look at what's happening behind the scenes. We're aware what type of energy we use. Okay, so here we go. This is by source. This is globe. We use oil. We know we use coal. We know we use gas. This is global. All right. And if you take a look at a country where this is Germany, not globally, but Germany, at the beginning of 2022, they were very proud that 40% of their energy consumption came from renewables. Right? They thought that was just great. This chart is showing you that we've actually improved our efficiency with the energy that we use. So what I mean by that is that today the US uses 60% less energy per dollar of GDP than it did in 1950. And that's just all about energy efficiency. So even though we use energy, we're getting way more out of it than we used to even 60 years ago. So the question is as well, have we moved the needle? So despite the fact, I saw this and I just had to have it. So when I talk about moving the needle to renewables, you'll hear a lot, invest more, invest more, invest more. And we do. We've invested $3.8 trillion. And what shocked me about this is that only moved the global reliance on traditional fossil fuels of oil, gas, and coal from 82% to 81%. So I asked myself, well, how is that possible? How is that possible when Europe is really proud of having 40%? How is that possible when North America has got very conscious about their energy consumption? Well, the answer is that those are economically developed countries, or OECD countries. Non-economic developed countries, or emerging markets, they don't care. They're emerging. As they move and they develop their economies and they forward their growth, they use fossil fuels. And they don't care if it's solar, they only care if they have any. And they are 80% of the global population. So that's really why, despite this tremendous investment, there's not been the type of result globally that you would expect. If you look at North America or Europe, you could see some results. But when you look globally, this is my reason to say that when you do any transition, it's going to take a lot longer than you think. It's going to take a lot longer. Now, this slide is about inventory. This isn't really very fun to look at, okay? But really the point of it is that we don't really have any inventory and we need energy. So yes, and you guess what, 2020, everybody go home, nobody do anything? Great, we got inventory. But today, we have these huge, massive draws, in China of strategic reserves in the US, because what they're trying to do is stabilize the price. So if we have a lower price, eventually you're going to have to put those back. Yeah. And I always say, people think that there's a battery tree. They had to ask people in California to not plug in their Teslas. You know what? If you don't know where your energy is coming from, just because you don't think when you drive your car, it doesn't mean it comes from a battery tree. It could easily be a coal-fired plant. That's a big issue in China, right? Which is a huge EV developing economy. That's electric vehicles. Why I put this one up is this is just the energy usage in a typical household. And I got this from Direct Energy. A lot of us get our energy from Direct Energy. And what I wanted to show you, why I wanted to put this slide up, was just to demonstrate that it really isn't easy to decrease your daily energy requirement. I mean, those are electronics. You can stop your electronics. Maybe you can turn your lights off. But are we going to turn our heating off? I don't think so. So this energy demand that we have, which I would expect to be consistent among emerging markets as they build proper housing, is one of the reasons it's going to grow. Okay. Now, Europe is really living this whole conflict right now, where the Green Party in Germany had to make a tough choice, which was, do we turn our coal plants back on, or do we let people die? So guess what? They refired all the coal plants. And you can see here that energy consumption projections are rising faster in non-OECD or emerging markets or developing markets. And that's going to drive demand higher for a long period of time. Okay, so this is all great, right? But what does that mean about actually buying the stocks? Okay, because that's where there's always been this very frustrating delineation for Albertans. Okay, so here's the problem. So we don't have support in the sector, so we've got this consistent underinvestment, and there's a plan for consistent underinvestment. You can hear, the President of the United States complaining. He's saying, oh, all these energy companies are giving back dividends. What they should be doing is investing more money so we can have lower energy prices. But they're not going to do that if you don't have support, right? So that underinvestment will create price support. Here's why people are paying attention. We're going to take a look at the yields on the energy sector. So right now, the average yield in the TSX is 2.7. If you go to the energy sector, it's about 4. In Canada, the energy sector has Cameco in there. It doesn't pay a dividend. So if I take that stock out, all of a sudden we're almost at 5. And by the way, excess profits, what did they do? They gave them back to their shareholders. And all of a sudden we're over 6%. That's why investors are interested in oil and gas today, or energy stocks, because they performed well and they do pay dividends. Energy security is now a new consideration, and I would hope that Canada would benefit from this. Okay, so we've got high environmental standards. We have a reliable and educated workforce, and our profits don't go fund crazy people, right? So I'm hoping that this is going to be a real thing. So now the next question is, how long is this going to last? And this is not very fun, but basically it's only going to last, these tailwinds for oil and gas in the stock market. I'm not talking about long-term demand. I'm talking about people wanting to buy those stocks and creating price support. It's only going to last until everybody forgets. And I want you to think about the floods of 2013. All the nice, beautiful areas downtown in Mount Royal, they're all flooded. And if you wanted to sell your house, you got a flood discount. Here we are 10 years later, all those price discounts are gone. So the same will be true of, the spotlight on oil and gas stocks, if you will. Right? So as right now, as soon as the war ends in the Ukraine, or oil prices fall, or traditional sectors show better performance, this sector won't be able to outperform any longer. But I'm not worried about those being considerations for 2023. So now what we're going to talk about globalization. And my joke is should I say deglobalization? The only reason I really have these notes is so that I don't talk for 3 hours. Okay, so the 1980s was, I would tell you, is really when globalization really got started. It really picked up its steam. And the concept of globalization is that you could take a job or a product that cost $10 a unit to manufacture in North America. You could send it over to, at the time, China or the Southeast Asia, and you could manufacture it for $1. So it was cheaper, so you could get more, you'd have higher profits. But the second part of globalization, or the concept of globalization, was that the person that had that job that made the item for $10 could now have a more meaningful job and earn a higher wage.
See, that's the theory.
That's the theory. And yes, and when Trump was elected, that was one of his big things, was that there are hidden costs to globalizations. His whole slogan, "Make America Great Again," et cetera, et cetera. He really brought that whole concept to the forefront, and he challenged it. And I would tell you that over the last 6 or 8 years, that concept that there are costs to globalization have been proved to be correct. So here they are. So what were the problems? We had data security. Data security became a real issue. That was Huawei. With COVID, we had all these supply chain issues. We're all very well aware of who's manufacturing our vaccines, right? And then the final one that I've been talking about is energy security. Do you really want to be getting 40% of your energy might be from renewables, but if you're getting the other 60% from Russia, maybe that's not a good idea. So these are all things that have led countries to do what we actually would call more protectionist ways. Right? And you can see that in corporations. So Taiwan Semiconductors, one of the stocks that has just been, is one of those ones that's not doing what it's supposed to be doing, but got hit with supply chain, it's got hit with this whole Russian war, because the Ukraine is where you get a lot of rare earths from. They're moving their manufacturing, they're opening massive manufacturing in the States so that they don't have these same supply chain issues. Because the number of semiconductors or the number of chips that we need isn't going anywhere. If you didn't get it, it doesn't mean you got it somewhere else. You just didn't get it yet and you're still waiting. So this is a big thing. And it will cost more money to manufacture those in Georgia than it will cost to manufacture it in Thailand. Okay, so how will it affect us? So for me, I talk about this as basically when you hear everything on the news and you still hear the concept of global economy, or there's going to be a global recession, I don't think of things like that anymore. I think of 3 distinct groups. I think of North America, Europe, and everybody else. So I'm going to tell you, my belief is that there's pretty much 0 chance for Europe avoiding a recession. Europe, I think, is going to have a recession. North America, I'm not sure. And if we do have a recession, I think it might be short. There's a possibility. We're already in it. But I'm way more optimistic for North America. Then if I look at the emerging markets, China, all of that, China's coming out of COVID. So that should mean they should have a good year because they've got all this growth compared to no growth. But I just don't want to invest there. I don't trust what's coming out of there. And when you come to the things that emerging markets are always offering, Canada, in my opinion, is a better option for resources, minerals, etc. So no to emerging markets. Okay. I'm totally changing gears here. Okay, so I'm going to talk about a lot of the things that you hear about that we generally don't invest in. So we're going to talk about the anti-establishment items. All right, so crypto, meme stocks, and NFTs. So do not put your hand up if you own crypto. I don't want to know. Okay. Okay, so if you turned on your TV today, you heard about crypto. It kind of went from riches to rags. So before we talk about the scandals, I want to clarify some terms and definitions so you can see where the future opportunity lies. So let's talk about definitions. All right. Why I think there's often a problem with these, with the whole concept of crypto, is people interuse these terms when they're actually vastly different. So the first one here is digital currency. CBDC. Does anybody know what that stands for? Who said marijuana? Good guess. Sorry. Who's central bank?
Central bank.
Central bank digital currency. It's a central bank digital currency. If you look in your own wallet and you think about how many times you went to the store in the last, month, how many people pulled out cash? Who pulled out their digital or their bank card, right? If we don't have a digital currency per se in Canada, but we don't really use physical currency anymore. You take it one step further, this is the sand dollar. This is from the Bahamas. The sand dollar, this is where we could be going in Canada, and I think pretty easily, but the sand dollar is their digital currency. So this is a digital currency. And what makes it different than your Bitcoin is a central bank digital currency. So it is centralized, regulated, stable, private, and secure, a secure unit of account, and it is a direct liability of the central bank in the Bahamas, backed by their foreign reserves. That's a real thing. Now in Canada, we don't need to buy sand dollars, but let's say that you're working in Uganda, I don't know what you're doing there, but just pretend you are, and you get paid, maybe this is how you want to get paid. Right? You want to have something digital. You don't want to be walking around with a bunch of money in your pocket where you run between the banks like you do in Argentina. This is a better option because it's more stable. So the next thing to talk about when you talk about digital currencies is crypto. What is crypto? Crypto, I always say, that's Bitcoin. I always say crypto is basically your Pokemon cards. It's nothing. There's nobody banking it. There's nobody regulating it. You're just making it up. So now let's talk about this for a second. Right now, there were, at the end of November, okay, anybody take a guess. Guess how many cryptocurrency choices were out there? 6, okay. 100? 21,000. 21,000 different choices. Now, of those 21,000, 9,000 are currently gone defunct. So, needless to say, you can tell that you are not going to find crypto in your portfolios with me. But I will talk about blockchain, and this is the other one that gets confused. Blockchain is the technology behind crypto or digital currency. And what blockchain is, it's the infrastructure that allows you to securely store, swap, and trade your currency. Now, when you say blockchain, people automatically associate it with crypto, but you don't need to. And I talked about this last year, but remember the euro issued an EUB using Ethereum blockchain. It wasn't Ethereum crypto, it was Ethereum blockchain. So the difference is that digital bond was issued by Ethereum, but it was in euros. Are you completely confused now? Good. No. But anyways, that's the three things here. So for Canada, okay, when you talk about Canadian banking, you've got to understand we're the number 1 or number 2 banking system in the world. Okay, we are the most advanced, we are the best regulated, we are the most secure, we are the best. And to your question, there's not a lot of difference. What would take Canadian, and I actually think about this, I think about the problems on the East Coast where people are super highly taxed. And what do? They do cash deals. Let's avoid tax. Greece, let's avoid tax, let's do cash deals. If you get rid of the cash, if you get rid of the physical currency, you just got rid of the cash deals. And when you get rid of it, because what happens if you get an environment where everybody says, I want to avoid paying tax, you remove your taxpayers from the base, and you create too much of a burden on the people that are paying the tax. So I think that what Canada would need to do, the only last step would be to create a system where people could internationally by Canadian dollars. And that would be then, so if we did that, and then we got rid of physical currency, yeah, we are a digital currency. So yes, we are. I would say we're 90% of the way there. And it's totally legitimate. Now, who here worries that they got an electronic deposit in their bank account? Nobody. Nobody worries about that. They know the money's there. Right? So, yeah, I think it's going that way. But it's being run by the banks, the digital part, not the central bank. Right? If you bank at National Bank, it's National Bank that does that part. To make sure your money's there. So coming to a legitimacy of the industry. So crypto, remember, this is crypto. They got investor interest when it went from $1,200 Canadian a unit to $25,000, okay? It got legitimacy when you had high quality institutions like the Ontario Teachers Pension Plan invest in that money. But I would tell you, this is the FTX scandal. It's more one for the compliance manual than the record books. It didn't work out. So there you go. So moving on to the next thing, which is meme stocks. Does everybody know what meme stocks are? Yeah, I didn't, yeah. Same thing. So basically what a meme stock is I'm going to go through them, but the ones that come to mind are GameStop, AMC, Bed Bath & Beyond, and BlackBerry. So basically what happens is you get this online chat group that says, hey, you know what? A whole bunch of people are shorting these stocks. We really like these companies. Let's get together as a group and buy them all and push them off the shorts and create price spikes. And they were successful in doing it through these online chat groups. You saw these huge rises at GameStop, went from like $10 to $80, et cetera. So they use self-directed trading to hike up the price, and they were unsuccessful in the short term, but eventually stocks come crashing back down. So the common comment here is, you know, you can ride the wave if you try and do that kind of investing, but be careful you don't crash on the beach. The next thing to talk about in this kind of new anti-establishment thing is NFTs, which stands for non-fungible tokens. So basically, I call it sort of digital art. This here is the first tweet by Jack Dorsey, who owns Twitter. If I look at this tweet, I think, okay, that's fine. I could snapshot it. I gave you a printed copy of it. Doesn't look very important to me. Guess what you could buy that for? Guess what it's worth? Nothing. I wouldn't really want to pay. I wouldn't pay for this, but somebody did. Yeah, 2.9 million US. Now, what it was worth. Yeah, well, this is the thing. This is my point, Fran. To your point about art, it's the value is subjective. I remember this from when I was a kid. This is a painting. Everybody remember this one? I thought, man, I blew it. I should have paid more attention in arts class when I was in kindergarten. Yeah, we bought that one. 1.8 million. So if this could be worth 1.8 million, I guess that tweet can be worth 2.9. Because when it's art, it's subjective. So the next point about that, moving right along, is yes, sports is another place you're going to see NFTs. Okay, so this is a jersey won by Diego Maradona when he scored his iconic Hand of God goal. Okay, people have always loved sports paraphernalia. Take a guess on this one. It's just a jersey. It's actually a jersey.
4 mil.
Who said 4 mil?
I did.
Somebody's bought sports stuff before. 9.3 million. It's a dirty t-shirt, man. Okay, but 9.3 million. Now here you've got, this is his NFT. This is digital. This is a digital trading card. It's not a physical one. You got a digital trading card. So this is worth 9.3. Yeah, you got it. This one's worth 4.3. 4.3 million. Now when you're looking at this, and I've got these priced in US dollars, what's really, one of the things, I think these are great. I think they're new revenue streams for the sports franchises. If a jersey can be worth that much money, I think a digital card can be worth this much money, if somebody's willing to buy it. But where I go with this is that the problem with NFTs right now, in my opinion, is you have to pay for them in crypto. Okay, so that's a problem for me. But I think that we could eventually get to a place where this becomes a legitimate art form. So who took a photo of me is going to try and sell it for $5 million later. That's serious money, right? Yeah, just waiting for one of my boys to say, hey mom, can you go get me that digital sports card of so-and-so? I'm like, yeah, okay. Oh, no, maybe not. Anyhow, okay, next slide here. This is more fun stuff. So this is the metaverse. So if you want to get, what the metaverse is a fake reality. There's a really great Spielberg movie, Ready Player One. It gives you a great understanding of what the metaverse is. But if you think about it, when I say a fake reality, think about when we have a Teams meeting, right? You can see each other. I mean, we know we're not really there, but you know it's really me talking to you or Laura, David, Brett. But the next level is, forget about having a fake meeting. How about a fake meeting room? You know, or a fake vacation, right? These are the next things. And this is where I really think the next level of growth is in the metaverse. So what it also is, in addition to being a kind of a place to go, it is a marketplace. Okay? So these are all companies that have made money in the metaverse. So you can buy for your fake living room digital Dolce & Gabbana handbags or the new Nike Airs. Guess how much money these companies made selling digital images of their products last year? Yeah, 252 million. I could not imagine spending $100 on a fake pair of shoes. $1,000 on a fake handbag it's on my computer screen. Oh, look, there's my avatar with a fake blah, blah, blah handbag. Like, I can't believe, but it's here and it's going to stay. My joke about the metaverse is, what about like Budweiser? You're buying fake beer. So if you drink 6 fake beer before noon, are you an alcoholic? What if you're 14 and you want to have a fake beer? Do you have to get fake ID for your digital world? I mean, I could go on like this for an hour, but it's a potential cheap growth place. If I was marketing at Adidas or Nike, I'm like, hey, who wants to have a special on my fake shoes with wings that let you fly? Because I know you can find some teenagers or some people that'll buy this stuff. So it is a marketplace. And, yes?
Is George Santos part of the metaverse?
I don't know. Man, I don't know. But I guess that's going to be the new way to live forever, right? Is you're going to create your own your own metaverse avatar, like Putin or Trump, and you're going to have your own castle that you live in with your own exclusive stuff. You're going to have your own staff that keeps your metaverse image alive, and you don't give your inheritance to your kids. You keep it for your metaverse purchases. That could be a real thing. Whole new movie plot happening right here. Anyways, but on a serious note, I expect those numbers to increase. Who's not on this list? Okay, Budweiser, which is another beer company, big one. Whatever. Great, Molson. If you're looking at what's 2%, if you're looking at Budweiser made $20 million selling fake beer, do you think you might want to make $20 million selling fake beer?
Yeah.
I mean, what's the cost of selling a fake beer? It's just profit.
It's like a bank.
No, a bank doesn't sell fake beer.
Jennifer?
Yes.
Who buys this?
Somebody, not me.
Can you sell it then? Once you bought it, can you sell it?
Yes, and I think this is where it's going. And you can see this in video games. This is why you have to put a control on your children's video games, because they buy their armor or their equipment, right, to battle in their game. And then there's only so many golden shields or whatever, and then you can resell it when you're finished your game. But yes, if you have a virtual whatever, and you have that first Dolce & Gabbana handbag with, I don't know, whatever on it, that maybe flies, you could resell it when you're done with it. Why not? But it's new and it's emerging. And it's just an extra profit line for companies, it is amazing to me, right? So if you're saying, oh, we're going to have a recession, people are going to have as much money to spend on running shoes, but little does the traditional analysts realize that they've actually created a whole internet thing where you have no manufacturing costs, you have no supply chain issues, you have no wage inflation. So when I'm investing in a company, I consider if the companies are doing this. It's not, of course, applicable to all industries. But you know what? Maybe it could be for a car industry. Hey, who wants to? Hey, Ferrari would be a great example. Nobody's gonna. Never going to see me buying a Ferrari. Would it be great to be able to buy a metaverse Ferrari? Or a supercar? You'd never crash it. You don't have to pay for car insurance. You don't have to wreck the environment with gas. Okay. Moving on. Environmental and social governance. So. When we talk about ESG, and why I don't know if I told you this, I took my ESG course from the CFA this year. That was a very difficult course, but I actually learned a few things that I thought were useful. So when we say ESG, we usually just associate it with the E. And the E is environmental, and specifically we associate that E generally with carbon emissions. So when I took this course, what I really found is basically there's no consistency with ESG. What one person's determination of ESG is not the same as somebody else's. But if you're a good company, you probably have good ESG policies. And if you're not a good, but if you have good ESG policies, you may not be a good company. So that's something I consider. So what I do to do an ESG rating is once a year, I take all the stocks we own, I put them through an ESG calculator, it gives me a grade. So our portfolio is an A. So if you'd like to know if you have an ESG compliant portfolio, we're an A, and you can go down to like an F. So we're okay. We're getting towards the end here. I know you've all seen this slide many times, so I'm going to ask if anybody else would like to present it for me. Okay. This is about our auto-callable notes. I'm going to go through this example. We buy these. We've been buying them for a long time now. They make money. They're volatility plays. We all know we saw a lot of volatility in 2022. So here's how they work. This was a live example. You invested $100,000. It had a 3-year term. It was based on the S&P 500 index when it was at 1,400. 1 year later, if the index was 1,400 or greater, you got your 8.25%, and you're done. You didn't have a choice to stay for longer. You were just finished. If it took 2 years, you got 16.5. If it took 3 years, you got 24.75. Now, before I get down to the negative part here, why I like this is in 2022, any that didn't get paid didn't really matter because you're going to get it the next year or the year later. This is going to be one of the things that snaps our portfolios back, our positive returns next year, is that if we didn't get it for some things, like the bonds that come due to maturity or these auto-callable or income notes, we're going to get it later. Okay, it's not lost ground that has to be remade up. So they do have a downside. In this specific one, if at the end of 3 years, the S&P 500 does not get back to 1,400, it just goes to 1,390, your principal is guaranteed. The barrier of protection, they have another one, on this one was 20%. So it had to be, if it was lower than negative 20 in 3 years, then you've got negative 22, you got negative 22. Having said that, this is what happened last year. In 2022, we had 9 that matured in their first year at 11.6. So that was pretty good numbers. We had 6 matured in their second year with a 22.9. Right? This is what I'm talking about. If you have to wait, you still get your money. We had 3 that came due in their third year with an average return of 34.85. So I like these things. We have 11 that are rolling over to their second and 3 rolling into their fourth. So since 2013, we've had 125 notes with an average return of 14.1. And where do the proceeds go? The proceeds go to the underlying investments. What are the underlying investments? Option contracts that are forward contracts because they're not publicly traded. So at the time you enter it, the contract is fixed. That's it. It's done. How do you get such good pricing? Volatility gives you good pricing. So when you're sitting there and you're going, your stock market account's going like this portion of your account is getting better rates. That's a simplification, but that's basically how they work. So they have a sister investment. They're called the income notes. Same idea, except these guys pay every month, even if it's negative, as long as it's above what's called this barrier. So yes, the prices look funny on your statements. You know, your $100,000 could look like it's $85,000, but it doesn't matter. If this has got a barrier of 30%, you still get paid. And they can last for 5 or 7 years. So these I look for to have longer lives, but in 2022, and I have to thank Brett for doing all the tracking on this every month, because he does it every month. This is how it works. I have a good idea, and then they do it. So we had 35 notes, and they had an average return of 8.6. And these notes pay monthly, and we received 98% of all the possible payments. So in last year, which was a terrible year, a couple of notes missed one payment or maybe two. But that still put us out at 98%, so it took my 8.6 to 8.42, which is still way better than what we could have expected. So you're going to keep seeing these as long as they exist in a. I have to say no to a lot of them. When we sit down to select one of these, I think we must look at 200 different notes, and then we pick out 4. Right? It's not. You're saying no a lot of the time. They are not GICs. Right? You have to understand how they work. Okay. Summary of what's going on next year. Really, I have a little bit more in fixed income, because I think fixed income has just got sent out to the death yard, and I think it's overdone. I think still good income notes and auto-callable notes. Very, very little international equity. Has to be pretty specialized. I brought back the U.S. and Canadian equity positions to be. I've been overweight the U.S. I think Canada's going to have a pretty good year next year. That's my expectation, because we have what everybody wants. Right, and that'll roll into our banking sector, and it'll roll into our economic sector. I wanted to point out on this slide, this is the first year we put up the difference in pricing between U.S. natural gas and European natural gas. Now, they actually are priced in different units and different currencies, so we did the conversion so you could see the difference. And this is why we like things with LNG facilities, is if you're looking at a high price of $5 for natural gas in North America and a low price of $21 in Europe, there's a reason we want to send it over there, right? If we run in at 10, if we end up equalizing at $10, everybody's super happy. So I'm a big, natural gas I think is a great long-term play, etc. Ooh, and financial planning. This is going to be our year of financial planning. So you have different stages in your life where you do different types of financial plans. Because we didn't make money in 2022, which has been it's been 13 years since that's happened. I'm not too happy, not too pleased about it, but that's okay. But I'd like to just let you all know we're just going to reconnect back to your plans, because we had lots of years where we made lots of money, and you think you're going to be confident you can stay retired, you can go on your vacation. You can buy your new car. You can have your kids can still have a wedding at a nice venue. It's going to be okay. And just as a side, from the financial planning point of view, I always give you that little checklist, and it's in your book. You can just check and make sure. Those are basic things. Is my will up to date? Read your will every 5 years. You might find out that your kids are adults and you need to change things. Hint, hint. Anyways, so financial planning. So expect calls from us this year. This is all the research we use in addition to the research from National Bank that helps us make decisions for your portfolios. Some research is really inexpensive, some is very expensive. My lawyers wanted to say hello. They wanted to go first, but I said they were last. And that's everything for me. Thank you for coming.